Hi Emily, how you doing today? My name is Cody De Freitas and I am your financial advisor. Today I prepared us a slide deck to walk through and go through some of the recommendations that we have prepared for you. So on today's agenda, we'll be talking about your profile, your current situation, some product options that we can recommend for your portfolio, and we'll be capping it off with a risk versus return discussion, some risks to be aware of when investing in the market. So here, Emily, as you can see, we have broken down your client profile and current situation. So you, Emily, the novice investor, are looking to contribute towards your TFSA. You are 24 years old, bringing in $55,000 before tax per year. You have $2,000 in your savings account and are looking to contribute around $3,000 to $3,600 annually towards your TFSA. You do have $8,000 outstanding student loan debt, and your goals and objectives consist of building long-term growth, contributing towards your TFSA and possibly FHSA for your home down payment in 8 to 10 years. You are looking to invest for around 8 to 10 years with potential for longer, and your risk tolerance is moderate level with a growth-oriented mindset and still seeking capital preservation for the long term. So you had a couple of questions coming into this meeting that I think I would like to address before we go ahead. Your first question being, should I be using mutual funds or ETFs in my TFSA? I just wanted to say that's a great question, and my suggestion is to consider investing in ETFs or low-fee mutual funds. At the age of 24, it is very important to see the impact that high fees can have on your portfolio over many years. Your second question, what would a simple starting portfolio look like for me? Given your moderate risk level and age of 24, I would recommend your portfolio to be split 70-30 or 80-20. This structuring allows for potential growth and provides some stability. A major consideration is to open a free home savings account to meet your goal of using money for a home down payment, and there are several benefits to be aware of. And your last question, how much could this grow if I stick with it? Well, returns are never guaranteed, conservatively speaking, with a 70-30 structuring, contributing $3,600 annually towards your TFSA over 8 to 10 years, with compounding in effect, you can expect a positive return on your investment nearing 6 to 7%. So now we can dive into our product options suitable for you. We have chosen 2 mutual fund and 2 ETF product options. Mutual fund number 1 is a Canadian Balanced Income Fund. And so why invest in this fund? This fund aims to provide investors with a stream of income, moderate growth, and a safeguard on their capital. This fund is rated low to medium risk, has a management expense ratio of 0.65%, and also provides a monthly dividend that can be used to reinvest in more mutual funds and help grow your portfolio. This fund invests mainly in high quality securities, and over 80% of its holdings consist of corporate bonds and equities, giving this fund stability and potential for growth. One thing to be aware of is something called an annualized standard deviation, which essentially tells us how bumpy the ride is going to be throughout the year. For example, an annualized standard deviation of 5.55% will let us know that this particular mutual fund can fluctuate up or down 5.55% within the year, and that is something to be aware of. So for each product option, we have also displayed a graph for you to visually see growth on your investment over a certain amount of time. For example, in this particular mutual fund, for your initial $300 investment and $300 periodic monthly investments, over 10 years, your investment would grow around to a little over $40,000. So our second mutual fund product option that we have recommended for you is a global balance fund. So this fund seeks to provide long-term capital appreciation and preservation by investing in high-quality businesses. This fund is rated low to medium risk and has a management expense ratio of 0.75%. It also provides an annual distribution frequency on their dividends. Its holdings primarily consist of dominant high-valued companies like Microsoft, Johnson & Johnson, and Amazon with AAA and AA credit ratings. The annualized standard deviation is 7.15%, which is a slightly bumpier ride. So this graph of the Global Balance Fund displays what growth on your investment would look like over 10 years. So at 10 years, you would have in total $36,000 contributed towards your TFSA, and that is broken down into $300 per month investments. And as you can see, at the end of the 10 years, your investment would be around $48,000. So now we can jump into our ETF product options that we've recommended for you. Our first one is a US large cap equity index traded fund. And so why invest in this ETF? So this is an index ETF that aims to replicate the performance of the market rather than quote unquote trying to beat it. It is a basket of stocks that offers wide diversification to help stabilize your overall investment. This fund allows you to own little portions of multiple companies all in one investment and offering a low MER of 0.06%. However, this fund is a medium risk with an annualized standard deviation of 11.1%, meaning slightly more volatile, but there is room for more return on your investment over time. The major holdings include companies with large capitalization such as Nvidia, Apple, Microsoft, Amazon, and Alphabet, which is Google. So this graph displays growth on your investment if invested since inception, and this particular ETF has been around for 6 years now. After 6 years, you would have total contributions around $21,000. As you can see, since this particular ETF is a little more volatile, it offers more return, but in times, as you can see, the graph shows periods of loss as well. So our final product that we have recommended for you is a balanced allocation ETF. So this ETF is built for investors like you who seek long-term capital growth, diversification, and regular rebalancing to maintain risk-first return. This fund is rated low to medium risk, suitable for your portfolio, offers a low MER of 0.17%, and an annualized standard deviation of 7.05%. It's allocated most of its holdings into Canadian and US financial and tech sectors, and a combination of federal, corporate, and provincial bonds. So again, this particular graph shows growth on your investment if invested since inception with this ETF. And as you can see over time, with less risk and less volatility means less return, however, more stabilized. So over 6 years, your total contributions again would be around $21,000. And here on this graph, you can see at the end of the 6 years, if you invested since inception, you would have around $28,000. So here we have broken down our recommended strategy for you into short and long-term goals. For our short-term goals, if you are looking to start investing tomorrow, my recommendations are to build up your emergency savings just a little more to provide you with liquidity in times of need. Secondly, I would aim my focus on continuing to pay off the remaining student loan debt if it is at a high interest rate. If it is at a maintainable rate, then I would continue to invest while paying it off. Thirdly, I would strongly consider opening a free home savings account to take advantage of the benefits they offer if you wish to purchase a home in the next 10 years. For our long-term goals, I suggest you continue with monthly periodic contributions towards low-cost ETFs in your TFSA and FHSA and let compounding take effect. This simple strategy can help attribute towards the goals and objectives you are seeking. So to cap off our meeting today, Emily, I wanted to have a risk versus return discussion with you. So when investing in the markets, there are things to be aware of, like market risk and behavior risks. Some ways to combat market risks in times of volatility are to diversify your portfolio by splitting between, say, 70% stocks and 30% bonds. Bonds act inversely related to stocks, meaning when stocks are lowering in value, your bonds are helping maintain a cushion by rising in value when rates increase. You can even further split your portfolio by allocating your investment into an index that includes multiple different stocks. You may also want to consider a quarterly or annual review of your portfolio to ensure you and your investments are aligned with your goals and risk tolerance. So, behavior risks. When it comes to investing, sometimes your own decisions can affect your overall return. This happens when markets are on a downturn and panic sets in. It is common for the investor to sell their investment at a loss, and in addition, will miss the rebound when markets turn around and recover. It is extremely important to be aware of your risk tolerance while investing and understand that markets can fluctuate time to time. And that concludes our meeting today, Emily. I just wanted to say thank you very much for taking the time out of your day to meet with me and discuss some recommendations that we have for you. And if you have any further questions, please do not hesitate to reach out to me and I will be happy to assist. Thank you.